All right, everyone. So let's start. We have a very good amount of participating here. So I see many people from many countries, a lot of new names. So that's very cool. Okay. I've asked a few moments ago how much you're familiar with supply and demand, so I know how much to emphasize on the basics. But whatever the general skill is here, we'll get to do most of what we're planning to do, which is to understand what supply and demand are and to plan our trade, and in specific to scalp supply and demand levels, but that only after once we understand what are supply and demand levels, what they are representing, and how to actually assess if these demand or supply zones will provide us high probability entry or exit. So let's start right off. So today agenda is what is supply and demand, and since I see many people here need to level up with this new information, I'll spend the first part of the session about this. I will teach you what are supply and demand in theory, and then we'll go to charts and spot some zones and see how the reaction is made and how we can plan our trades upon this. We will talk about what qualifies a quality supply and demand zone, and then we will learn to see that supply and demand zone, the way that we actually draw them, they are actually out of just plotting the zones, it's already made the trade plan almost incomplete. So in supply and demand, as simple as it sounds, once you draw the zone, you have your entry, you have your stop loss already defined. The next thing you need to do are two things: is now how to handle the trade in different scenarios and where to exit. So these are the two things that will left for you to do. And then we'll talk about a method that I use for many years, how to scalp these zones, how to actually in practice use the information that we gather from reading the charts and take this into the level of trading. Just remember, being an analyst, to analyze, to do technical analysis is a totally different task than actually trading it. So we'll talk about this, and then we'll talk about supply and demand risk management, scalping risk management. I'll show you some insights. Whoever went to my webinars before will probably going to see these charts that I'm talking about risk management, but I really like to repeat this because the more we talk about this, the more you understand what to expect from your own trading regarding your statistics. So a little bit about myself. My name is Gil Ben-Hur. I'm trading Forex for 14 years. And I used to be an independent day trader. I used to manage portfolio equity accounts for private clientele. I was a partner in a very large trading community that specialized in advanced price action, supply and demand, order flow. And we were conducting free workspace for anyone who wanted to learn and expertise in the advanced price action theories that we were learning together. And we also, upon demand, were conducting a premium education program. Once we were doing that, we gathered a lot of a team of good traders. We wanted to establish a common funding environment. We've created something, but eventually it didn't work out. I took all the setup that I've created for that group and shifted to public, and I found The5ers.com, which is a funding traders and growth program, mostly for Forex traders. You are invited to go and see. This is enough commercial information. If you're interested to be funded and learn how it works, you can go to our website. That will be the end of commercial today. Let's talk about supply and demand. Okay, so the basic of every market is the balance between supply and demand, the balance between how much commodity are on the shelves versus how much people wanting to buy. Forex, stock markets, futures, everything is being measured by the balance of how much buyers are there versus how much commodity is there to provide them. So in terms of supply and demand, we call the commodity. In this picture, we see all these medicine at this pharmacy. All these medicines on the shelves are the commodity. This is the supply. And we see this in that picture, that the shelves are full, but we don't see any clients. So this represents a situation where there's enough or more than enough commodity, but nobody is coming to buy. What this guy who is the store owner needs to do in order to bring more people, he needs to do some discounts, to do some promotions. In other words, it's lowering the price in order to bring people to justify the daily expense for his worker and for the rent and for everything, right? So it's a very common sense. But what happened if we're going to look on the left side and we see so many people are just crowding to get your product, and they just want to take everything. This represents that there are more people willing to buy than there is commodity. It's hard to provide the supply to all these buyers. So what happened? What can this store owner do? He can raise prices, because by this, he can sell the same amount of commodity that he has in the store to less people, but with higher price. Okay, so this is the relationship between buyers and sellers. And this applies to everything, to a shop in the mall or in the street, or into the advanced electronic environment of the financial markets, like Forex, commodities, stocks, futures, whatever, you just name it, okay? Everything is determined, everything is priced by the relationship between buyers and sellers. Who decides if price will go up or down? This is the exchange. Today, the exchange are automatic computers that gets an input of zillion and trillion of data inputs every millisecond, and they process all this information and decide if price will go up and down. But this is at the core essence, has no difference from the very simple tomato stand at the market, okay? Supply and demand is the very core atomic logic to determine if price will stay in a range, if it will go up, if the product will become more expensive, or it will become more cheap, okay? So same thing with the financial markets. And so let's focus on the financial market side, because we understand the logic. Trade is when two sides agree upon quantity of price. Every time you see a candle or a price that is printed on your chart, that means that there are two sides, that somebody had sold something to somebody else. If there's nothing there, you'll see a gap, okay? You'll see just a gap between the candles. But if there is a tick, this means that there was a documentation of a deal that was happening in this market. So everything is very, very real in the market. It's not just numbers going off from nothing. So just remember this, and reading charts will start making sense on every twist and turn. I can promise you that. So when we say that two sides need to agree upon price and quantity, and then we have a deal, what happens when the two sides don't agree about this? Okay, somebody will push price lower because he wants to buy cheaper, and the other side will push price higher because he holds a commodity and he wants to sell at higher price, right? Every one of us was at this situation where we wanted to sell, I don't know, our house, our car, whatever. When we were sellers, we wanted to sell expensive. When we wanted to buy that car, we wanted the discount. We wanted to buy it cheap, right? So everyone has his own incentive to push price into a certain direction, and that is when the market is really living from. These clashes between two different incentives, two different motivations for what happened in price. And there are so many different participants in the market. There are big sharks, there are manipulators, there are money makers, there are simple traders, there are speculants, there are countries involved, central banks, and there are also hedge funds. So each one, and there's a high frequency trading. Everything is blended and boiled into just one candle that tells us a story of open price, close price, high and low, as simple as that. But we try to read the chart and see the story of what is the collective narrative that happened through the clashes of these all these participants. We don't cover this much today. If you would want, we can talk about this in different webinars. Okay, so let's see this in another different way. So if we have enough people asking for the commodity, and the commodity, there's enough commodity to give the people that demand, price will stay. In our terms, in chart terms, it means price will range at a certain price approximate. Okay, so this what we call a balance or a basing area where demand and supply are meeting and coexist in peace. At one point, there's going to be a change in this balance. So there are two types of change in balance. One is that demand exceeds supply, where there are more people asking to buy that commodity. There's not enough commodity, so price will go up until there are enough sellers that will get enough buyers to be satisfied. What happened to price? Price is going to be higher than it was before. The opposite situation, if there are more commodities than demand, people are not coming to buy, price should go down until they find more buyers that are willing to buy that commodity at cheaper price. Easy. So here, the next demonstration is maybe I think it's the most effective way to look at the balance of supply and demand in the market, and then we'll go to charts. So imagine that at the exchange, at any price level, let's say euro US dollar at 1.1, okay? There are certain amount of people willing to sell at 1.1, and there are certain amount of orders willing to buy at 1.1. We can see that there is already a difference in the order flow, in how much people are willing to buy or sell at that specific level at 1.1. Okay, so in this demonstration, we see that there are, let's have just the pointer here. We see that people are, there are less orders, there is less supply to satisfy all these buyers. And imagine that each file needs to find a matching file. Each commodity file needs to find the same amount of buying files. Okay, so let's start subtracting the level of orders of the supply to demand, and we see that we have all these orders left at 1.1 unsatisfied. If the exchange task is to create these deals, we have all these people very, very happy. They get at 1.1 the product these guys are selling, but at one point this pile of sales order is getting down, and when it's on zero, we have a leftover of buyers at 1.1. What happened to these unsatisfied buyers? Very easy. When we have unsatisfied buyers or sellers, these orders are left there, and this what we call an order flow. At 1.1, once price will come back there, now price will go down, definitely up, because there are more buyers and we're looking for more sellers willing to sell, so so price will go up. Once price will return to 1.1, these buyers will be the first ones to get executed. Next time price will come down. So this is our strategy. We are going to search on the charts, where are these places where market had decided to push through a level to break the balance between the sellers and buyers. And once price will get there for the first time, we would want to sell or buy according to what happened in the past. Okay, let's talk about this in charts. We see, and now we look at the charts, and what we want to see is just the story of buyers and sellers, nothing else than that. Okay, so when we see price is ranging, that means we have a balance. Okay, there is an agreement between buyers and sellers, but once price is dropping down, we know that there is more commodities than people willing to buy, right? So price will go down until they find more buyers, and then buyers come into the market. They are buying. There's enough commodity that being sold at pretty cheap, okay? And now there are more buyers than sellers, so price will go up. And again, price is basing, ranging, there is agreement on the market, and then sellers, there's more supply than demand, so price will go down until it's basing, and again and again and again. This is the only thing that we need to read from the market at this point, okay, just to understand the order flow. So let's see how we actually plot the supply and demand zones. So we're looking for a decision point. Where is that point, that price level that the market had no way to fulfill the demand or the supply? And I think it's pretty logic to see this on the naked eye. And but let's play with some colors. So first, the first stage to find it is to see the most obvious. We see a drop in price. We see an impulsive, or we call it a pole. Okay, we see big candles moving up or down. Very easy to spot, right? So this is what we're looking for. Every time price is moving up or moving down, these are the poles that we are just marking. Next thing is we are trying to figure out where was that point, where was that decision that we can say that from that on there was no further fulfillment for the other side. If we're looking at this area for selling, okay, because we see prices obviously went down, so that means there are more sellers than buyers. Okay, so where was that point where the sellers actually exceeded the buyers? Where was that point? So the convention talk about the neck, the last point after the reversal. So if we just zoom in for this, we see that price went up. We see on the reversal, and it's, guys, and it's very, very easy because we're just looking at what happened. Okay, so we have the whole story laid out for us, and it's very, very easy. It's not where we trade yet. Okay, it's where it's what we're analyzing. We're analyzing where are left orders that were not fulfilled, and we will wait for next time to price to go there. So it's very, very easy to spot, right? We see price going up and reversing and going out, going down, right? It's not our trade. We just learned about what happened in the history. So at this point, we see price going up, and from that on, price is going down, right? So this here is where the market had decided to go down. So we mark this line, okay? We mark this neck line, and above the top and just on the top, the very tip of of price went in there, this will be our outer border for that zone. So now we have the zone. Now we have the supply zone, because This is where price had decided to go down. And we assume that at this decision point, this is where we will have people that were willing to sell but didn't find buyers. So if we go back to that chart, you see, we have less, at this situation, we have the opposite situation. We have more people willing to sell than people willing to buy. The market had matched everything, and the net has a leftover of sales order. This is what happened right there on the top, right? So there are leftovers of sales, of people willing to sell, of commodity, of supply, right? So this is where we assume there are left orders that are waiting to be triggered in the future. So now we have our setting for the trade. This is the supply trade. Okay, now let's look once price went back to this supply that we've marked here. Price had reacted to this area. So now this is a very important thing to understand. We can't expect that every time that price will go and hit a fresh supply or demand zone, that it will actually reverse the trend, but it will create a reaction. Okay, so this is what we can expect from the market. If it's going to evolve into a reversal, it's not yet to be said. But what we can say with a high probability is that once price is returning to a fresh zone that was never been visited before, this is where we can sell at the case of supply, because we assume that there are unsatisfied sellers here that didn't meet enough buyers. Once price is coming back, these orders are waiting here. So they will execute the supply and demand core price movement that the exchange is obligated to. Okay, so therefore we get a reaction. Okay, so we see that once price is coming back the next time, it will penetrate more. Why is it penetrating more? It's penetrating more because the orders, the sell orders at this level that we've marked before, were giving out. There are no more orders here. Therefore, there are more orders waiting upward. So another rule that you have to write yourself down in very big capital letters is that at the second touch at the zone, or any other touch at the zone where it was already being touched, we cannot tell how much price will go in furthermore. So there is a huge uncertainty of what's going on. The only way that we can explain that turn is if we would go to a lower time frame. This is copper H4. If we would go to, let's say, M30 or M15 or M5, we might find here a fresh supply zone up here, and this might explain this. I don't have the chart to go and dig here, but that probably would explain this as a fresh. But if we would want to trade that H4 level at the second time, we must not do any selling here. Must not, okay? It's no rule for you. And also for the third time, even though it reacts, it's a no. We don't take it. We take only the first one. And believe me, I will show you that you can have as many trades you want within a day on these levels just for the first time touch. So we don't need to hassle and take unwanted risks on the second and third and more levels. And remember that levels are always going to be broken. And this, and a lot of people mentioned here before, support and resistance, that it's pretty much similar to supply and demand. This is the difference. Support and resistance will show you where there is support or resistance in the market. But if you don't apply the order flow logic into this, you cannot tell if that level will hold price for the next time it go there. Same thing applies to trend lines. You can never know if the trend line will hold or not only afterwards. But with the supply and demand theory, with the order flow understanding behind the supply and demand, you can decide where to take higher risk or lower risk with your trading. And once price is already being visited, that zone, this zone is no longer in your trading profile. And that will basically keep you out of trouble in the market. So let's move on. So like we've seen the supply trade, which determine the entry and where we put stop loss. Okay, let's see the demand trade. So we have this impulse here, and the decision of price to go up is right here. Once price come back for the first time, it reacts. You see, we see price going up and then it reacts, and then again and again. Remember, second time and third time are not to be traded. But when price is bouncing off this, it actually prints another demand zone. This is where the decision was taking for price to go up with actual significance. It was breaking supply that is right here. Okay, and since it was broken, we can assume there are more power for the buyers. And once price is getting back to that yellow zone, it reacts. Okay, in this situation, it reversed, but we cannot know that for sure. Okay, so here's another supply. The decision is right here on the neck. We have the outer zone of the supply, which will determine where we put our stop. And once price will go there for the first time, boom, we get a reaction. How much? We'll measure that in a second. Okay, so here we have supply and demand. And remember, the trade is being established once a supply or demand was created, and the trade is once price is coming back here. So we have a trade here, okay, because we already have the supply established. So this is where we can trade, right? So how we set our trade, like we said, at the decision point, we will set our buy order. We will put our stop loss, and the potential reward for this had given us about 4-to-1 or 3-to-1 risk to reward ratio on this one. On the sell, we put just below the line, we put our sell order. Our stop loss will be above. And for here, the potential reaction, I don't say that we know how to measure this just yet, but just look at what happened in the market, okay? What we have risked and what we have gained. It's also 3 or 4-to-1 risk to reward ratio that happened in the market. I'm not saying we know how to take this as a TP, but This is what the market had provided, okay? In my trading rulebook, I'm much more modest than this because I want to have the high probability trade cycle from entry through risk, through management to take profit. Okay. So let me read some questions. Do you want me to overview more about supply and demand, how we mark this and everything before we go into the scalping? Because we're just going to shift to another material and then we'll wrap everything together. Yes, 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 yes. Okay. Okay, so let's just take live charts. Where is it? All right. Let's switch to live charts. This is okay, found it. Okay. Can everyone see my charts? Okay. Good, good. Okay. Real-time charting. Okay. Euro US dollar. Let's see what's going on with the Euro US dollar H1, which is my favorite time frame. By the way, we always get that question, so I'll answer it before it being asked. What time frame should we use for this? Any time frame. I can show you the same price action pattern on M1, on monthly, and in everything in between. And if you can create a candle that is 3 minutes and 33 seconds charts, you will see the same patterns. Okay, so it works because this is how price move. Price is not candles, price is not time frame, price is price. When there is a price level, when there is an order flow waiting at the exchange to be fulfilled, this is where you see reaction. So it's price is timeless. Okay. Muhammad is really suffering from my pointer, my red pointer. So out of respect, I'll stop using it. Okay. Let's continue. Cool. So what do we see on H1? Euro US dollar at this very very current time. So easy to see, price was climbing up, it was ranging and reversing. Where is that decision in the market for price to be reversed? First, we have that top. This is where the last deal was made. The seller had sold at the highest price and he sold it to a buyer that bought it at the most expensive price you can find lately. Okay, this is what happened. This is how we look at the charts. It's not about numbers, it's about participants doing deals in the market. Okay, and then price was ranging. A lot of people came to agreement about this price, and then something happened. There were more sellers than buyers. Buyers had decided to stop buying at this level. They decided it's not worthwhile to invest in euro versus the US dollar at this point. Where is that point? Where is that level? I would mark it right about here. Okay, right about here is where I see price for sure had broken the ranging level, and from that on it went straight down. Okay, this is where I would mark my supply for next time for price to come. So I'm marking that rectangle and I will stretch it all the way to the far future. And then once price will get there, I will sell here with a limit order and I will create stop loss. We'll use a drag and drop. We'll put our stop loss right above this area. Okay, right above this zone. So this define our untouched supply zone. Okay, this is untouched supply zone. We want to sell right off that decision and put our stop loss above. This is the current situation for this trade. We have about 39 pips, 39 points to risk for this trade, right? Next, price had gone down and it was flagging upward very slowly. We can say that this is a type of ranging because for almost every price that there was a trade in it, there was another retest and coming up. So it was crawling up and then price was turning and falling down. We can see this with the naked eye, right? So if this is our pole, where is that decision made in the market? Right about here. Okay, this is the region of the price move that actually had make significant lows. This is why we mark it right here. And our zone will be at just above the tip of this. So we have another supply that was not touched yet. So the trade, let's just move this away. So our trade will be right about this line again. We would want to sell here. And put our stop just above. Now it's about 8 pips. And remember, we see this off the 1 hour chart, okay? We have like 8 or 9 pips zone, and we can get much more than that. Now, if we take just 10 pips, we're at 1-to-1 ratio. If we take 20 pips, we're about 2-to-1 ratio and risking only 7 pips. That's very cool. So here's another supply. Price went down and now flagging up, and then it reversing, and we see that strong moving down. Let's mark it down. I would say decision was made here because we see price went down on that spike, went up, and then from here, this is the region for breaking lower, right? So we mark this as the decision point, and above the tip, this will be our zone. Okay, it's not just right. And now see how price had actually reacted to this zone pretty much precisely. You see that the same concept that we are applying here have given us a very precise action of price. Okay, so let's see if we were selling this, because now this zone is not valid anymore, because once we're touched, this is not valid. Let's mark it. No longer valid supply. Why? Because it was touched, right? It's no longer from here after the first touch. But let's say we were here in real time and we could have placed our limit order right here, right off this decision point and put our stop loss. Our trade would be about 10, let's say 11 pips risk. And off this, we get almost zero drawdown and 37 pips potential move down, okay? Let's mark some demands that are untouched. We have price going down and then moving up. A decision was established here, so we have our decision right here. And our zone will end at the tip. At this situation, we have somebody buying at the very, very cheapest price and selling for somebody that was sold at the cheapest. He was a desperate seller, probably. And this would be our decision point. So we see that this is an untouched demand zone, right? Or we can call it fresh demand zone. If it's a fresh demand zone, we can buy right off this decision level and put our stop right below the outer level, right? Okay. Now it's going to be a 20 pips zone. So for any of you that are not used to this concept, I know a lot of traders that would go to the market, and this is another thing that is distinguishing between support and resistance to supply and demand, that supply and demand actually define for you where do you put your stop loss, okay? While in support and resistance, you have just one dimension line and you don't really know where to put your stop, maybe above the next level, but that will determine a very, very wide range where you willing to risk your trade. With supply and demand, you have a very fast conviction whether your trade is going with your favor or not, okay? So at this point, with this level, we have stop loss defined for 20 pips, okay? And once price will get back here, we will buy and we will risk 20 pips. Don't take my words for it, because we were not talked about if this is the right trade to take. So don't do it at home alone if you don't know what you're doing or what you're expecting from here, because sometimes you see price just pushing through and not respecting enough of the level that you're in the way you expect, because it has more to understand why it is so. We will cover this in the next webinars. We have 5 sessions, new 5 sessions about supply and demand here in investing. So make sure that you sign up for this after this webinar. Okay, so we have a fresh demand. This is only for the theory to talk about. Okay, here's another fresh demand. We see price went down to lower low, and then from here it was rising up and creating some significance, breaking this level, and from that on it was hold and made more highs from that point. So the decision point is very simple to spot on the eye. Here's our zone. It's fresh demand. Let's just copy this, right? It's a fresh demand zone. So once price get here, we would want to buy off this level, and our stop loss will be just below that zone. At this time, it's 14 pips. It's 14 pips. Okay, so you can go on any time frame on as many as currency pairs on Forex, and you can always have these first zones waiting for you. And you can just trade with set and forget limit orders. Just place them while you analyze and go do your things and go and see what kind of reaction it gives you. Remember, don't copy anything that we're doing here today because it's just for the sake of education, and we're talking about taking profit or where to exit at profit, because if we don't take the right profit, price can return back on us. It's not always reacting as a reversal. And so we will be having the reaction, but not taking the profits. So it's very important that you don't copy what we're doing. It's just for the sake of understanding how we set the entry and the stop loss after we understand where is that decision point, where are these unfulfilled orders waiting to be executed in the future. This is the whole concept. This is the only thing that you need to know. It's just a pure naked charts, squares, and nothing else than that. Okay. Let's cover some questions. Okay. There is a question if this goes for stocks as well. Yes, it goes for stocks, it goes for commodities, it goes for futures, it goes for anything that has enough liquidity in the market. I wouldn't say that supply and demand would work if you go and trade pink sheets, that every $100 order will shift price in massive way. But if you trade Facebook, if you trade Google, if you trade Boeing, if you trade Amazon stocks, they have enough liquidity. There are so much enough participants in that specific market that the supply and demand situation can be seen and not will be violated or being abused by traders that foresee what other people are trying to do, try to hunt your stops or anything. So so just mind that the more massive the equity that you're trading, if it's a euro US dollar, which is a huge, if it's anything with the majors, if it's the gold, the silver, all the metals, corn, copper, whatever it is that is massive, if it's the big S&P 500 stocks, if it's the big indices, that would work for you. Okay. Would the long buy plan be changed if the price drops very fast? Okay. Calvin K, is it Calvin Klein? If it is, I'm very honored. Joking. So he's asking if if we should, in other words, you're asking if we should consider the way price is approaching the level. So in this example, we see price is falling, and I don't know if you ever heard, if you're willing to catch a falling knife, right? It's kind of, but eventually price had was pushed here. And if we look at this, if we went to go to a lower time frame, I'm not sure that I have enough data for this, but if we go here, we are going to see price going up and down and basing here and creating and printing another demand at mid-range. This is what eventually holds price. So if we know how to manage risk at mid-basing levels, it's in the supply and demand, we call it rally base, rally base, rally base, rally base. All these bases, and they have decision points. And this is a decision for price to go significant higher. And this is a decision point for price to go significant higher. And this is another point of decision, another point of decision. So we have enough decision points at the range. So we have on the inside, okay, I'm not saying that we know how to practically take these trades, but we can explain why price is moving up and down, and what made price falling there. So we can see here a mid-range supply, and price is scrolling down and reacting. But at the same time, we can see price is dropping and being held by a lower time frame base area with a decision point, which we could not take it. But we can see that either way price is coming, they're respecting levels for some reason. Okay. So so it doesn't really necessary that you will not trade through a very strong push or through a crawling pattern, price pattern. Okay, but I have to say that in the next classes that we're going to give on investing, we are going to dive deep into into supply and demand theory. We're going to go very deep, and we will define what is really happening when price is crawling, what is happening when price is hitting very, very strong into a direction, and what it tells us in terms of the story of the market, the narrative of what happened in the balance of buyers and sellers, and what can we expect if price is approaching our level at this specific price action or at this specific price action and many other price action. Okay, so we'll have everything plotted and talked about in the next session. If anyone wants to, somebody's asking when is the next class, go to the webinar section on investing.com and sign up for the next 5 sessions, which we're going to cover in-depth supply and demand theory. And like we're saying, where we see supply and demand, I'll give you a spoiler. With the same theory, we can say where there is no supply or no demand. That will help us to also assess if we want to take a long or short at a fresh level. So there are much more to cover than we'll do today, but this is just a spoiler for you to sign up for the next session. We're in an hour already. We're lucky that we're using our own platform. So we'll spend a little more time and try to talk about scalping, or would you like to talk more about the supply and demand? Let's talk about scalping. Yeah, let's talk about how we actually use that very simple concept and how we actually try to make money from it. Okay, because we've seen where we want to trade, but what is our expectancy from these levels? What for sure can we take from the market? Because you know, price can react very, very tight and then continue. So we're busted. We're not taking the trade. We were taking the risk. We were busted. We paid for the for that trade with a loss, but we really have to define the right attitude, the right goals for what we're doing. So let's move back to the let's change it back to the presentation. Okay. We'll do it fast. Okay. That's for you, Muhammad. I'm not doing the red pointer anymore. Okay. So what do I want when I come to scalping? What do I want to take from the market? Forget for a second everything we talked about in terms of supply and demand. What is it I want from the market? I don't want to have trades to go and brag and show off in forums. I want to take money home. I want to take netto pips and bank them into my account every day at the highest probability. I don't want to have sexy trades to brag of. I don't want anyone to admire me. I want to take pips home. So my goal is very, very modest. I want to take 1 or 2 trades a day with 15 pips each. I want to net at minimum 15 pips a day. Okay, 15 pips a day. If I would take more trades, maybe 30, maybe 40, but my minimum is 15 positive pips per day. I'm not talking about money, I'm talking about pips. Okay, so in order to find 15 pips, I need to take it off something that of a reaction that I can think or assess that it might provide a 40 pips range. Okay, so if I want to take 15 pips, I would want to apply this on a price action, on a price approach of maybe 3 times higher than what I'm trying to take. That will promise me that I will have a lot of success, better success, better probability for having a reaction, a decent reaction to take my desired 15 pips, right? So I don't expect that if price was ranging like 10 pips below a level and to take this and to expect to have my 15 pips. I still have commission and spread to pay. Price can go much higher than this. Okay, you get my my idea. So I will look for at least a minimum of 40 pips range. And then I will need a high probability entries. In my definition, I should be 66% right and and taking my desired profit, my 15%. It's not a win rate, because win rate can be 2 pips win, right? 15 pips is what defines wins. Okay, so I want to be correct in my trade more than 66%. That sounds very, very high rate. You have to agree with me, right? Is it achievable? Is it doable? Yes, it is, because I'm going to show you that I'm using something that is not common in terms of risk management. Okay, and one more or two more things to cover. I'm looking for trades that will give me fast conviction. I don't want to drag a whole day and go and let my trade um, um, get into a deep drawdown and to just drag me for a full day and night. I don't want that. I want to trade the extremes, the dips and the tops. I don't want to trade mid levels, because price can go very, very deep on this. So I would go for the extremes just because of that, because I want fast conviction, and we have enough of them every single day. Okay, so that defines for me that I would analyze M30 and up, specifically H1, which I love them, and daily. I don't like H4. They are not, for me, it's, I don't like them anyway. So I would do daily, I would do H1, I would consult with the weekly and the monthly as well, time frame. This will be where I mark the time frame that I use to analyze the levels that I want to trade from. Okay, and now let's talk about what I'm doing to increase my odds, and I will explain why I'm doing so and why it's okay to do so. Every single of you that went to trading classes were taught the very easy concept, the very simple concept that we're all trying to achieve and being frustrated for not achieving it, which is to trade a very high risk reward ratio, right? So we've been told that we want to trade at least 2 to 1 risk reward ratio, 1 to 2 risk reward ratio, okay? And here I've created an Excel sheet that calculates what win rate should I have to be a break-even trader, not losing money and not earning money, just being a break-even portfolio trader, okay? So if all my trades will be 1 to 2, meaning I'm risking 1 unit and asking to gain twice as that, I will have to be right in the market only 1/3 of the time, 33%, meaning that out of every 3 trades, I have to be right twice and losing 1 just to be a break even. I can increase that and have a 1 to 3, 1 to 4. That's for 1 to 4, I have to win the market 20% of the time. If I can find trades and I can be trained to find trades for 1 to 5, 1 to 10, I can be only 1 out of 10 trades being right in the market. You all understand this, right? So, but I'm asking myself, what will not make me frustrated? Can I maintain a good and healthy way of trading routine where I'm losing 9 trades out of 10? Can I count this? Can I consider this until I have that runner that will give you 10 times from what I've risked? And how many trades should I take and how many entries should I take? how much the commission and the spreads will cost me for that. This is for me something that I'm not saying that it's not good for other people, but for me, I'm looking for instant execution. I like fast conviction. So I cannot work with this. It's my personality. I'm not saying it's yours, but you can take or do the same calculation on your Excel sheet and find out what is good for you. I'm telling you what I'm doing for my own. So I'm using the opposite way. I'm saying, let's see what will make me a break-even trader if I would risk much more than I'll be willing to take. Meaning that I'm willing to risk 3 times more than I'm willing to take. Let's say I'm risking 40 pips. My win will be expected win will be 13.3 pips. Okay, if I'm risking 40, right? So for that, I have to be correct 75% of the times. I have to be correct. Out of 4 trades, I have to be right 4 times. But now I have this tool of supply and demand. I have this rule for the first time touch. I have high time frame levels already being created. I know order flow is waiting out there. I know it's a high time frame. I'm not looking for reversal. I'm just looking for a reaction. Okay, so if I'm doing so, I can absolutely build my strategy on risking 2 or 3 times more than I expect to take. And at least for me, my rate is higher than 75% because of that, because I take the extremes, because I take very lower hanging fruits that are there out there. I don't want the sexy trades. I don't want to show swing trades. I don't want to hold on trades overnight, over the weekend, over the session. I want to take few trades a day, fast execution, fast take profit, and go home. And if I'm risking 3 times or 2 times or twice more than I'm willing to take, I will have better odds to meet that target. And if it's off a daily or H1 levels, fresh levels, I will, for high probability, will actually get it. Okay, so I'm using negative risk reward ratio. Maybe it's not responsible for me to say this, but this is my trading plan and it works for me. Don't do it on real money before you actually train and see that it works for you. Know your own statistics, know how you can spot the trades and how you can use it wisely, know where your statistics is, and then you would know what kind of trades you're looking for or what kind of risk to reward ratio you need to use. Okay, so so my trading plan, back to supply and demand. We have to do it fast. So on a ranging market or on a trending market, I have to understand what I want. On any level, I would want a fresh, untouched levels. But on the ranging market, I can trade both ways. On a trending market, I would want to trade only the market bias. I would wait for price to go into a certain direction, wait for retracement, then take a fresh level of retracement activity. Okay, on ranging market, I can trade both extremes until it gets broken. Okay, so so we have the trending market and we have the ranging market, and let's see, we just need to move faster on this. Okay, let's move back to a few examples. A few examples on the charts, and then we must end this session. Okay, so let's take a different. Let's take just a random chart. It's the GBP USD. Let's say this has not came yet. We see price is ranging to specific to specific direction. We have this decision point. We've placed it. Okay, it's an H1, right? Now price is approaching here, and I'm selling off this decision point. Price is pushing against me at 12 points and giving me my definite 15 points. I don't want more than that. Maybe people would laugh at me not taking all this potential of 180 pips, but I'm taking only 15 because I'm taking only what I want to take. Okay? Oh, I'm sorry. I'm not showing the chart. Okay. Sorry, guys. Let's do it again. H1, cable, right? Let's imagine price has not yet came to this. I'm not saying it because I see it. I'm just want to explain, okay? So we know that we have a decision point right here, right? We see it, okay? Or we can be more easy on this right here, okay? At lower price. We have this zone. We would, after this supply was established, we would sell this decision point, right? So we have a limit order. We have our stop right above, yeah? And price is coming for the first time on an untouched. And what happened? It makes a drawdown of about 12, 13 pips, and it gives me my definite 15 pips. We have a range of almost 190 pips here, but I'm only taking my 15. I will not curse myself at the end of the day that I could take 180. Of course, you know, it's very frustrating to exit and to think that you've lost something. You have to train yourself not to look for that. I'm looking to gain my 15 pips. This is my goal. The market had given me that. That's okay. So we have the power of selling tops and buying dips because we have our supply and demand theory with us, and so we can trade extremes, and we also wanting to take very few pips from the market so we can achieve our target more times than being busted. So only the first fresh touch at the first zone, and only 15 pips, right? So we would be risking here about 26 pips, 28. We can shift it all the way to 40, like our plan, and we've made our 15. So that's perfect. Okay, we don't need to take more than the 28 pips. So we don't have to spend 40 pips if that wouldn't work. Here's a trade that wouldn't work, but I would probably take. Okay, we have this demand right here. This is the decision point. Okay, it was bounce off another demand. okay, right here. So I believe it would have worked. Actually, it wouldn't. And then if I would buy from here, let's see, let's measure, it would go pretty close at 12 pips, but then I would get busted at 26, not meeting my 40, but that trade wouldn't work. Once we cover more in-depth supply and demand, we would not take this trade just because of the simple idea that price was not breaking a level, not coming from a breaking supply. If price is not coming from by breaking supply, we assume that the buyers um, um, the buyers are still not strong enough because supply wins. Okay, supply wasn't surrendered to the buyers, so we don't want to buy against this. We have this early signal, but we'll cover this. But let's stick to the simple plan, right? So again, price is not making significant lows, then we cannot sell this one, right? Okay, here's another trade here. Price was making up a decision point, right? Price is coming first time to untouched area, 8 pips drawdown, 18 pips stop loss, and give us the definite 15 pips right here. Okay, here's another supply right here. I just love supply. Okay, price was touching here. I don't know if I could take that trade. If it wasn't hitting this, maybe I've missed it. And then if I still consider this untouched, we will be busted right here. Okay, only 20 pips. Here's a mid-range demand, the decision point made right here. Okay, price is dropping. I buy here, very precise, almost zero drawdown. We get 29 pips potential, so we definitely have our 15. We risk only 21 pips, okay, of this decision at mid-range. So you can see that with H1, you can have so many levels to trade off, and you can see these spikes that you probably weren't giving them enough attention, but these are actually moves, and these are lower hanging fruits that you just taking them, and most people just ignore them. But this is money. This is 15 pips for sure that we have here on a decision level. Okay, let's look up for more examples. Okay, here's another supply. What happened first time? We get our 15, 40 pips, potential 15 pips for sure, right? Risking 21. Okay, this is off H1 on cable. Demand, here's demand zone, decision point right here. Let's stretch it, see what happened. Okay, first time price reaching this demand, 0 pips, and giving us on the spike, we were already out very, very fast. With a range of 80, we get our definite 15 pips, risking 30. We're not near our 40, 45, okay? More. Here's another decision point right here. We would I would definitely try to take it. If we look closely at the first touch right here, let's see what happened. We would buy right here. Price would go exactly 15. I don't know if we would make it because of spread, but that had given the target. At some cases, really depends on spread, okay, or not. But we were risking 25. So this is how I trade off the supply and demand. This is how I scalp. Remember that the concept is that I'm looking for fresh extreme levels. I know where our orders are laying out there, and that are waiting to be executed for pretty sure, with high probability, not always. When we learn deeper into the supply and demand theory, we will know how to screen even more false entries like this. So that will would probably go bring our odds much better. Somebody's asking, for example, on commodities. I cannot, because of the platform here. Our platform is only for Forex, so I cannot do it now. Maybe in the next sessions, we'll open different charting systems and I can show you. But if you take the concept that we're covered today, take it on commodities, you'll see for sure that it's working. I see that on the I will send you a poll regarding the webinar. So I would really appreciate if you tell me your honest view on this. Let me read some questions. Chart. When you teach high properties. Okay. There's this guy, anonymous attendee, asking very intensive if we teach about probability retracement. I'm not sure I understand the question, but yes, in the full course that we're going to do next on investing, we'll cover that as well. Okay, all right. Okay, so I don't see more questions that we haven't covered today. So there's a good question I'd like to address. Somebody's asking why I don't trail my profit and take only 15 pips. I think I said it. I'm looking at my job at trading my view is about how I manage portfolio. I don't care to take more than I'm willing to take. The more I want to take, the more I need to risk, and I want to take my definite pips. Sometimes I would get it easily. Sometimes it will be more tight to take. Sometimes I don't have enough range. Sometimes the price will move 17 pips and go. So if I'll push my stop loss, I will end up break even too much, too many times, and that will ruin my statistics. I'm looking at being a portfolio, at a successful portfolio manager rather than taking the single trade and optimize it. It's just not the right way for me to manage the money in the overall concept. I want to take money from the market. I don't care if it's good looking or not. Okay, so that's the kind of patience and discipline that many traders are not taking enough. They are not considering this enough. And guys, life, Instagram is not life, and everybody on Instagram, they having great lives, right? But we know reality is not like this. And when you go to forums and when you look at your mentors and the people that you follow and you admire their work, and they showing you the perfect trades and the perfect exits, it's exactly like Instagram. They're showing you the perfection, the book, the classic book type of trading, but they're not showing you the dirty job of trading. What we're looking in trading is to gain profits and pay for our bread and butter. This is what we expect from the market, and not to be admired on forums. So the reality is much more complex. This is how I learned to be more disciplined and to be more modest from what I expect to take from the market. So I take high probability from levels from high time frame and use it and take very little from it, but I take it plenty of time. And if you follow this concept and do a back test on this very concept on any commodity that you want to do, on any asset, you will tell me how many trades you can find within a single day. You decide what session, the New York, the London, the Asian, whatever. Find that session and you see that you have at least 4 to 5 trades off the H1 daily, weekly, monthly levels to trade and pick just small and minor moves and make your bread and butter very easy. End the day flat, go with no worries on your head, sleep well, and open the next day fresh. So, okay, guys, thank you so much. We were really extending this 30 minutes more than expected, but I was very happy to share with you the concept of supply demand. I really, really urge you to go and check out the in-depth course that we're preparing for you on supply and demand. We will cover much more stuff about this. We will learn when supply and demand levels are intending to be broken. We will know much more than that. We will know to assess the powers in the markets where there are no supply, no demand. We'll do everything in reverse, in and out, and with the knowledge that you will gain with these concepts, you can apply and add to any trading concept that you're already being mastering. So it's not contradicting anything. It just gives you the core reason for why price is moving. And remember, price that is printed on the chart, they are not just numbers. It's something happens for real. There are real trades between real participants in the market, and what determines if price go up or down is the very simple, core, universal, timeless reason that is supply versus demand. Where there's no supply, price will just go up. When there's no demand, price will just go down. When there's more supply than demand, price will go down. Simple as that. Nobody can break that rule. This is how the market works. Okay, unless you work something on a market with no liquidity, that is a different thing. So when you keep on the big markets, you're safe to go on this. Thank you so much for being here today. Make sure you sign up. We begin in 2 weeks for another 5 weeks, just covering supply and demand in depth. I hope you sign up. I hope you check out what the 5ers has to offer for you. If you wish to be funded as a Forex trader, you can find it for yourself or share it with your friends. Thank you so much. Have a good night. Bye-bye.